Hello viewers, this is Dr. Alok Chajid and you are on Already Late, your favorite channel for simplified learning of personal finance, investing and economy. Whenever you come across any investment option offered by the government, what's the first thing that comes to your mind, or first couple of things that come to your mind? Safety, guaranteed returns? Yes. I have seen many investors investing in government bond mutual funds or gilt funds with the same belief. They believe that they would get stable returns without any risk. In this video, I will share some insights about investing in government bond funds and how the investment is definitely not risk-free and the returns are anything but stable. Let us start by taking a look at where your money gets invested when you invest in a government bond fund. The image on your screen shows you the portfolio of HDFC Gilt Fund as on 30th June 2021. I am using HDFC Gilt Fund only for educational purpose and not as a recommendation to invest. As you can see, all your money is invested in only government securities. This means there is practically no risk of default on any of these securities because the likelihood of Indian government defaulting, not going to happen. That's definitely not going to happen. All that the fund manager needs to do is hold these securities till their maturity and earn annual interest on the same. A very simple thing to do. Buy government securities, earn annual interest, and get your money back upon maturity. So, where's the risk? To answer this question, we need to look at one more aspect on the same portfolio page of HDFC Gilt Fund. Do you see that every security has a number at the beginning, 6.97, 7.17 and so on? The number indicates the interest that the particular security will pay every year to the investor if you keep holding them till maturity. Well, let's say the fund manager is holding the 6.79% GOI 2027 security. Now this means he will earn 6.79% interest every year till 2027. Now consider this, the fund manager earns 6.79% and there are a lot of expenses around. You may get 6.2% or 6.3% roughly before factoring for any taxes. Now ask yourself, is this return before tax attractive? The answer is no. And you look at most of these securities are offering the returns in the same range. So what does the fund manager do? To give you better returns, the fund manager, instead of holding these securities till maturity, trades in them. To illustrate this, look at the data in this table. The table gives you the top 10 holdings of HDFC Gilt Fund as on 30th June 2020 and 30th June 2021. You clearly see that there is a lot of change in the portfolio over the 1 year period. This clearly means that the fund managers buy and sell securities on a regular basis. If you want to know the extent to which these fund managers transact in their portfolios, have a look at the turnover ratio. Turnover ratio, in a simple language, it indicates the extent to which there are transactions in a portfolio. Higher this ratio, higher is the churn in the portfolio. That means the number of times the securities get bought and sold. Just look at the turnover of some of the gilt funds over the last 1 year. The numbers are a clear indication of large amount of transactions in the portfolio. These transactions result in larger fluctuation of NAV of these gilt funds. A closer look at the NAV of HDFC Gilt Fund over the last 10 years since Jan 2010 gives you a lot of insights into the behavior of gilt funds. Over this period of time, the last 10 years or 10 and a half years, on almost 60% of the occasions, the NAV has been positive on a single day basis and 40% of the times the NAV has dropped. This means on a daily basis, if you check, 60% of the times you were better than the previous day and 40% of the times you were getting negative returns as compared to the previous day. Negative returns, government securities? Yes. Now, instead of daily, if you look at monthly basis, the monthly returns, so you then see that on 72% of the occasions you have monthly positive returns and still even after holding for a month, 28% of the times after 1 month also your returns would be negative. Now, yes, this number drops to 6% on a 1 year investment period and absolutely zero for 3 years and 5 year period, which means if you're invested for more than a year, 3 years, 5 years period, you would not have got negative returns since Jan 2010 till now. Okay, you did not get a zero return or a negative return. Let's look at one more important aspect. Let's look at the fluctuation in these returns. Over a 1 year period, now you see on your screen, the return ranges from minus 2.8% to over 22%. Such a wide variation. For a 3 year and a 5 year period too, you see the returns are varying. They vary. There's no consistent, no stability in the returns. Now, does this not go against the basic belief that I first spoke about in this video, earning stable returns? So by now, it should be clear to you that expecting to earn stable returns in gilt funds is a mistake that you should never make. Another problem which comes with not holding securities till maturity is that you are exposed to interest rate risk. This means the value of your investment will be affected by change in interest rates. The growth in investment value and the interest rates share a strong inverse relationship. This means when interest rates go up, debenture prices goes down. The extent of this relationship can be understood by looking at the modified duration of the fund. Higher the modified duration, higher is this risk of fluctuation. Look at the screen. The modified duration of most gilt funds range from 3 years to 5 years. Now, this will result in lower returns whenever interest rates are expected to move up in the country. To summarize what we have understood so far, gilt funds do not hold securities till maturity. The returns fluctuate a lot and can go negative as well. And the returns are exposed to interest rate risk as well. So the question is, why invest in these funds? If you are looking at stable, guaranteed returns and willing to lock your money for a few years, you have many options like PPF, NSE, and so on. If you are looking at investment with liquidity and returns with lower fluctuations, more stable returns, you have mutual funds like ultra short term, and low duration funds. If you are looking at higher returns and are comfortable with higher fluctuations, you can look at large cap equity funds, which of course will come at slightly more risk than a gilt fund. So where do you put gilt funds in your investment scenario, in the landscape? The answer is nowhere. Yes, you do not need to invest in gilt funds as they do not serve any purpose which other options cannot give you. I hope you liked what I have shared in this video. If yes, please hit the like button. If there is anything that you want me to answer, you want us to interact, drop a comment, and please do not forget to subscribe to my channel if you have not done it yet, because you are already late. Thank you. Happy learning.